Okay, we are live for the Gamma Optimizer Room live video. As usual, the first question is if you can hear me and you can see my screen. No? So my software, my streaming software says that everything should be okay, but we'll see. Okay, yeah, the problem with YouTube is that the delay is longer than GoToMeeting, but it seems that it's working. So okay, so let's start this. Welcome again. Let's see what do we have for today. So we have some closed positions. Today we are going to have a closed position. It's most likely going to work. I know it was tough to enter last week to this thing, so you can always try to enter before I send the notification, because the trade is already in the variance center, so you could do it from there, or you could play with the price a little bit or play with the strikes in order to enter. So I enter just when I send the email, and sometimes the futures move a lot after the market close, and then that's why the trade changes a lot. So I think this one in particular went negative, no, after the futures move up substantially higher. So anyway, so it's a jackpot, and I'll take it. No, so far so good. Okay, let's look at the market regime. Market regime is very interesting. The GT level is right now 4,195 SPX. It's very close to where the market is at this moment. It's only 8 points below where the market is trading right now. Supremely close, although that's because we have tons of puts expiring today. We have a massive amount of puts expiring today, and all of those puts are around 4,200. All of them. It seems that everyone went crazy buying puts for today around these levels. So we'll see. It's still an hour. Who knows if they're going to get paid on those puts or not. Most likely they will not, but the net effect is that the gamma from those puts is really pushing the GT level up a lot. So once today's expiration is over, we should see the GT level around 4,185 tomorrow. So it's going to come down a little bit, but nothing changes the fact that the market is basically struggling at this level. It's either consolidating, I mean, depending on your view, if you're an optimistic, the market is consolidating to go higher, or if you're pessimistic, the market is topping and about to crash, about to have a strong correction. The net case is that market has been struggling to move past 4,200. It has been a psychological barrier for a while. It's what I call a wall of worry, Market participants seem to be really assigning a lot of meaning to it. It's just a big round number, So the proposition is very simple. We either take off from this level or we have to correct. The market rarely stays in the same range for a long time. So I think it's more than a week now that we have been at these levels. I don't know if the market can sustain another week of this thing. The thing is, we have enough macroeconomic data coming out this week and next. We have job numbers, and we have a lot of production numbers and CPI being released next week. So something will have to give. The market has to go someplace at least within 1 week. So next Wednesday or next Thursday we'll know what this thing is doing. But I know it is really hard to watch the market consolidating at these levels. It's really hard to see it and remaining there, in particular for those of you that are playing those ULG trades. I don't think this is a good environment to keep playing them. That's why I don't do them. This is a perfect environment for BRP trades because market is doing nothing. So let's look at the term structure. Let's see. I think let's look at the volatility review. I jumped directly to the term structure. So notice something interesting in volatility. For the past month, volatility is kind of low, almost 14%. But for the past week, it's only 2%, 1.9 for the past week. That's not a typo. The market hasn't done anything on the last 5 trading sessions. market has been pretty much around the same level for a whole week. And you can see it then realized variance. There is no variance whatsoever. Market hasn't done a single thing. Market is just stop. And that means that market participants are just on the sidelines at this point. Why are they at the sidelines? No idea. They could be because there is uncertainty and they don't want to add to the positions, but at least, if you want to take something positive out of this, at least they are not liquidating positions. At least they are they are content with the particular positioning they have. There are no massive rearrangement of positions, but it might happen once the macro data is released. Notice also that VIX is it looks low. I mean, it's 1646, but compared with the realized variance, is a tad overpriced. It's still a little overpriced, almost 4 full volatility points from where the realized variance is. So option dealers, they are not worried, but they are still not giving away options. So that's what I see in terms of volatility. And remember, you can ask questions in between, and remember that because this is YouTube, questions will take a little longer to display for me. So try to get them in and don't despair. Okay, now let's look at the term structure. So I am comparing this with the May 21st, which is like 2 Fridays ago, not this Friday, but the one before. And remember that the blue line is the current volatility, and the red line is the one from the 21. And you see that, at least in terms of option prices, there is nothing happening there. It's not that option dealers are really worried. I guess they are pricing summer effects already. So the summer effects are already here on option prices. They seem to be a little cheap. The curve is a nice contango, but still 100 days and out is still expensive. I see it as expensive. But at least for the near term, the market is going nowhere and is good. So this curve is actually really good. I don't see anything there that will worry me in the next 5 trading sessions. In terms of realized variance, it's the same thing. Notice how low it is. It has been below 10% for more than a whole week. So realized variance is back to boring levels. You can also see VIX normalizing a little bit there after a period of craziness. And this points to a market that has no action. Where are market participants? Is everyone just content watching TV, or is everyone on the beach or on the Hamptons? Everyone is just basically, I don't know, check it out. That's where it looks at this point. They might be waiting for data, but the thing that is surprising, the thing that really bothers me a little bit with the whole macro data thesis is that it's already priced in the market. I mean, the market is already pricing positive data numbers, like good job growth is already pricing and tame inflation. So I don't know what the guys are waiting for. Maybe they are waiting for bad data. I don't know. It's hard for me to know at this point. I really don't know what to think. I think that, like, if we go by history, we go by what has happened before, it's most likely that the market is consolidating to go higher, but I don't know. I'm not certain of that. But at least in terms of realized variance and implied volatility, it seems that dealers are thinking the same. It seems that options dealers are thinking that the market is consolidating to go higher. Are they right or wrong? Hard to tell. They tend to be right most of the time, but who knows? So right now I don't have money on that bet. I am just watching. And remember, the only trades I am taking are the VRP trades if there is an edge for them. Okay, so ambiguity. Ambiguity is moving up again, and it is not a surprise, because remember that ambiguity tends to be inversely proportional to realized variance. So when realized variance is really low, ambiguity tends to go up, and that's what we are seeing. Ambiguity is going up massively. It already cleared the 0.2 area and is arriving to the 0.3, and you notice the last time we were there, the market corrected a little bit. So will that happen again? I don't know. It might take 2 or 3 weeks for the market to arrive to 0.3, although if realized variance continues at the 1 or 2% per week, it might arrive really fast. So let's keep an eye, and next time this thing crosses 0.3, I'll let you guys know, so we can protect any longs, because it has been fairly, like you see the last time, like you see that the ambiguity has struggled to pass 0.3 since the beginning of the year. After the correction at the beginning of the year, the market struggled to pass through it. So, since 2020, since the crash of 2020, ambiguity hasn't surpassed 0.3. So that's a level to keep an eye on, and I'll keep you guys posted about it. Any questions so far? It seems that I'm going really fast through the presentation with very little feedback. Everyone seems to be really quiet or don't know how to type questions in Google. Or maybe you're watching in like time shifted, so the questions won't arrive in real time. Anyway, so what is the trade plan? The trade plan for now is no ULG trades. Please don't do them. I am going to remove them from the Variance Center. I noticed that a lot of people take them, more people than I'm comfortable with are taking them, and those trades take a lot of hits, so I am going to remove them. I'm sorry about that. You can do them by hand if you want. If you really want to go to the trouble, go to the trouble and compute the probabilities by hand using the ultra calculators, but I won't display the trades anymore. The only trades display from the Variance Center will be the official trades, which is the VRP 203. So that's kind of my plan. So let's look at the Variance Center a little bit. So the market, you can see is still around the 4,200. The GT level is really high. It's 4,196 and getting higher because the gamma of the puts that expire today is getting higher and higher. And you can see it here. You can see, I don't think you can see my mouse, but if you notice that there are dark lines around 4,200 and below, those are all of the puts that are expiring today. Most of those puts expire at 4 p.m. today. And they are adding lots of short gamma for action, and that's where the market accelerates a little bit when it tends to go to the 4,200 area. But let's see, hopefully those will expire wordless today, and then we have a gigantic hedging wall at 4,250. That will be like the next hurdle for the market. Who knows? At this point, the market doesn't seem to have that much energy, and we might need to wait until September or October to see a bigger move in the market. In terms of kurtosis, it has been elevated today. I'm surprised that kurtosis has been so elevated. And remember, this value that is displayed here is only for the last hour. So since 2 p.m., kurtosis has been elevated, probably around this dip. Probably someone came in mass to buy the dip, and that's what pushed kurtosis up. But after this dip was 213. In 1 minute, I expect kurtosis to go back to 3, and it's going back to 3.65 because it's only 1 hour. So 1 hour will be covered pretty soon. I have a question. Yeah, based on seasonality trends, mid-June to end June is minus 1%. Can you advise on this aspect? In terms of price, I don't think that there is much I can advise. I really don't follow price here. When I look at seasonal effects, I look seasonal effects on volatility. So, but to me, if we're going to talk about seasonal effects, is that June has almost no volatility. Also, 1% down in a month is nothing. We have seen 1% down in 10 minutes before. We have seen 1% down in less than one session. So 1% down in a month is like noise. This is statistical noise. There is no actionable information. Knowing that the June will fall 1% is not actionable. It's not tradable. Like, we cannot trade based on that. If you really are concerned about a 1% move down on the market, which is nothing, it's only 40 points. So I don't know. Maybe you should reduce long exposure, but I will prefer something like 10% down. 10% down is nice. It could be play, or 5% down could be play, but 1% down is nothing. Market could oscillate. What we need to figure out is if we can trade volatility, because if we trade volatility, then if we know the volatility is low, so we know that those BRP trades are going to work really well, because they benefit from really low volatility, and at the same time, we'll know that the ULG20 trades will not work. So these trades will not work. So stay away from these trades, folks. Please stay away from them, at least during the summer. I don't think this will work at all over the summer if the market doesn't move. And you notice that the market hasn't moved at all in the past week, so all of these trades die because those are long gamma trades and they require a lot of movements in the market, as opposed to the VRP trades that are short gamma trades and require the market to stay quiet. So if we know that June is going to be kind of a quiet market with very little movement, then we can take advantage of that. That's my comment. Another question: is there a way to know from the gamma imbalance when a specific set of puts of calls are expiring? Not really. I mean, one of the reasons I know that those are puts that expire today, these ones here in the 4000, is because most of the time, if you notice, most of the time gamma is distributed every 25 points. And a reason for that is because most of the gamma that is present in SPX options is present on the standard options that expire every third Friday of the month. And those are heavily used, and when they are introduced, the strikes are only spaced 25 points apart, and that's why you tend to see these walls 25 points apart. But then you notice that these puts in this area, in the area from 4,200 to 4,150, are spaced every 5 points. So this is a weekly expiration. And you notice that there is, even though it's only 900 million, 800 million, 1 billion here, 1.4 billion there. I mean, this is kind of elevated for the weird strikes they are using. So that's why I have a feeling that they are for today, because the gamma for the options, gamma becomes really strong as the expiration approaches. And the expiration approaches at 4 p.m. In fact, in theory, gamma will be infinite, no? A few minutes before 4. So I have seen these bars grow all day long. They were really little, and then they keep growing and growing, and that's how I do that. But there is no, I mean, I will be able to, I mean, I do have the data by expiration, but in the chart I don't have the ability to display it. I might add a filter here that you can see the gamma for every expiration. Maybe it could be a good addition. The Gamma Central has something similar to look at open interest. Maybe I could add something here just to see it by expiration. I don't know if it's something that I will do. I might, I don't know. We'll see. I have a suggestion from Jim. Could you add the mean and standard deviation for the 3-day ultra? Okay, I mean, I have resisted adding ultra 3 to the standard ultra information, because there is already too much information. So I wanted to redesign this table first, so perhaps get rid of everything and only display mean and standard deviations for Ultra 5 and forget about all of those things, because all of those things could be computed with these two little widgets, no? So maybe I could do that, then it frees a space for Ultra 3. I could do that. Okay, now that we are looking at Ultra, those of you following the Freddy indicator will notice that it's flipping short again. It's coming short again. If I do quick math here, it's coming negative. So we are going to have another negative signal. I don't know the past one. Did it work? I mean, it has been flipping really fast. They flip negative, then it flip long. Now it's flipping negative. And if tomorrow the mean is of certain values, very likely that it will be long again tomorrow. So it's lots of noise in this area for the Freddy indicator. Okay, I have another question. Hi Leo, can you comment on how we are so close to GT level, yet near-term put prices are relatively cheap? Yeah, well, the GT level has nothing to do with the prices of puts, no? It is. We are close to GT level because lots of people are buying puts and they are pushing the GT level up. But the prices of the puts depend on what dealers want to charge. If dealers want to overprice them, they will overprice them. So they are not overpricing them because they are not seeing anything wrong. Okay, so you could see this from 2 points of view. One point of view is that when the market is close to a GT level, and by the way, remember that the GT level is an approximation. It's not that the GT level is exactly 4,196. It could be, I don't know, 10 points up or 10 points down. So for all practical purposes, the market is neutral. At this point, dealers don't have to do anything. This is one of those points they love. No, they love to be when the market is like here because they don't have to hedge again. Like they hedge in the morning, and they don't accumulate deltas anymore because the market is not moving. So there is no hedging activity. And so that's one way to look at this. It's good for dealers because they are having a blast. They are selling options and they are hedging them, and then the end of the day comes and they don't have to re-hedge them again. So in that sense, it's good. And then the other thing is the prices of options, and this is something that you have to remember. The prices of the options don't obey supply and demand. There is no supply and demand laws that apply to derivatives. Derivatives can be created from thin air. Okay, of course there is some friction there. I mean, there is some friction because you need to hedge, whatever. But what applies is that there could be millions of people buying puts, and it doesn't mean that the price will go up because the supply of puts is infinite. There is no constraint in supply. Okay, so derivatives are not constrained by supply, or mostly are not constrained by supply. So therefore, the laws of supply and demand don't apply, and therefore the pricing of these options depends on the whim of the dealers. Basically, you are paying whatever the dealer wants to charge you, and apparently right now the consensus is that they don't want to charge you that much. So that's what it is, and it's not related to the GT level. Okay. Another question. We all know you love popcorn. Are you going to open popcorn tomorrow? I don't know. I have the feeling, this is not really quantitative, but my gut feeling is that we'll continue consolidating long gamma. We have been consolidating long gamma for a whole week. There are plenty of excuses and opportunities for the market to be short gamma, yet it has closed long gamma. We'll see. I mean, there is still 40 minutes on the session, and something could happen from here to the end. But as long as the market keeps closing long gamma, I don't see why this could not work. I don't see why we'll flip. Okay, I have a comment from TC Spear. The last Freddy flip short was good for approximately 2 points. Well, that's good. At least he didn't lose money. No, the Freddy flip makes some money, so it's better than minus. No, so at least it's good. Okay, so in terms of Ultra. Ultra has been, even though the mean has been negative for a little bit, this is like nothing. This is statistical noise. It's very close to zero. Remember, I keep telling this to you guys all the time. The mean in a perfect universe should be zero all the time. The deviations from the mean like this one, like 0.44, are meaningful, or deviations like this one, minus 0.44, are meaningful deviations. But this thing, for instance, 0.05, this is nothing. Even 0.12 is like not really much. Compared with the standard deviation, this thing is a fraction, is 1/10 of the standard deviation, and this thing is even smaller than 1/10, is 1/20 of the standard deviation. So the mean really doesn't have much to do, but yes, Freddy is flipping. And you can see we have no trades today. There is no go for the VRP trade, so no, don't follow it. Okay, so let's come back to the presentation. Questions, more questions. I think that's the end. I guess it was a short video. Again, my feeling is that we are consolidating here, and I tend to be a little optimistic. As long as we close long gamma and we keep closing long gamma, I think this is a consolidation for a continuation move up. Of course, I mean, an asteroid could hit, data, jobs data could be terrible, the inflation could be 20% next week. I mean, who knows? But at least for now, it looks that we are okay. We are like right there consolidating. It's a question. It is safe to assume that once the puts expiring below 4,195, that the action will attract lower rather than push below. No. That's not a safe assumption. It's nothing to do. I mean, the puts expiring today are already hedged. The only thing that they are doing is that they are making the GT level to be higher than it should be. No, that's the only thing there. Like option dealers are not going to chase those puts. No one is going to screw you out of your puts because dealers are already hedged for them. They don't care if they have to pay or not. They already have the money to pay in case you have to pay. So it's not, the price will go to wherever the organic action will take it. This is something important. I'm going to take the last 5 minutes to emphasize this point. Hedging activity by dealers really is not leading. the hedging activity from dealers doesn't lead the market leads first. Okay, something has to move the market first, and usually it's organic trading that moves the market. And sometimes the market goes up because a lot of people are buying, sometimes the market goes down because a lot of people are selling. And once the market moves is when dealers have to hedge their portfolios again. So when they re-hedge the portfolios, they might make the situation worse, or they might slow down the situation depending on the regime. If we are long gamma, then they slow down things. Now, if the market is falling and dealers are long gamma, then they come to buy and they slow down the fall. And the same with the market is rising and they are long gamma, they have to sell, they slow down the upside. So long gamma hedging activity slows down the market, but they react to it. And in short gamma is the opposite. In short gamma, the market falls, dealers start selling, and they add fuel to the selling, or they add fuel to the buying, but they react. They are always reacting. Dealers never take the price any place. Market goes to a place because that's what it is. It's organic. I have another question. Could the BRP probability be used to play the opposite trade? Well, yeah, that's an interesting question. I think some members have tried to do that. I have posted some historical data. If anyone wants to share, I will say that I don't think that there is that much edge because the recall of BRP-T03 is very low. So it has low recall, which means it has lots of false negatives. So if you have lots of false negatives, you don't want to take the opposite trade. No? You will be screwed on the opposite trade. So in order for a system to be able to be played on both sides, it has to have very, very good recall. And I think that the recall from the BRP-203 is decent, but not too good. So I will not recommend doing it, but we'll have to look at the hard data. And I think that's it, folks. I think this is for now. Thank you for attending the short live video. This was a little delay, and this is a short week, so I don't think there is a point to do it on Friday, unless there is some dramatic action tomorrow or even Friday morning. I might schedule another one, but if nothing happens this week, this was it. I hope you have a great day, and I'll talk to you guys in the room. Take care.